Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. SaaS stocks have been all the rage the last few years, but they've really come crashing down in the last 12 months. And there's a good reason for that. A lot of companies grew as fast as they could, but at the expense of generating a profit on the bottom line. Now that investors are focused more on profitability than they are on growth, it makes sense that a lot of these stocks are falling out of favor. But long term, the software as a service business should be very profitable, especially for companies that are ingrained and can grow with their customers over the course of many years. So as the market has turned lower, I think it's time to start looking for potential deals in the SaaS market. And I'm looking for companies that are established, have a great niche in the market that isn't going to be disrupted very easily, and where stocks are potentially trading at a value to where they were even before the pandemic. The three I want to highlight today are DocuSign, Workday, and HubSpot. These are companies that businesses all over the world are using. They're critical tools, and that's why they're now on my radar. These aren't stocks I own yet, but I'm getting more and more interested in them as their price comes down and as they start to cut costs. My name is Travis Hoium. Thanks for watching Riiv Investing. Please subscribe here on YouTube to get updated on all of my content. The first company I want to go through is DocuSign. This has really become the standard company for signing legal documents in the cloud. If you have bought a house or a car in the last few years, it's likely that you use DocuSign. It's just the standard service that everybody uses right now. As a result, this should be a really great business long term, but it hasn't been a great stock, and there's a good reason for that when we get to the bottom line. But I want to start with where the company is today versus where it was a few years ago. Right here, we have a chart of DocuSign's revenue change over the last 3 years and its stock price change. So over the last 3 years, revenue is up 150%, but the stock is down 21%. So DocuSign is arguably more entrenched in the world of signing legal documents today than it's ever been, but the company is actually worth less. One of the reasons for that is that DocuSign is still losing money. You can see here $133 million net loss in the last 12 months. That's not great, but if you look at free cash flow, which pulls out non-cash items like stock-based compensation, the company's actually generated $386 million in free cash flow over the last year. So now that we move into 2023, I think the focus will be less on growing at all costs and more on generating positive returns from the revenue that DocuSign does have. So I think we should see revenue margins and free cash flow continue to go up. And given the fact that the company is starting from a base of positive free cash flow, that's a much better position than a lot of SaaS companies are. It's possible that DocuSign goes out and acquires some of the companies that get into more financial trouble over the next couple of years, or even that DocuSign becomes acquired itself because it's a valuable business. So I think when you're looking at SaaS companies, this is a very established business, positive free cash flow. It's not easy to value the company based on a price to free cash flow or price to earnings basis, given the fact that it's not generating that income right now. But strategically, I do like where the company is positioned in this, and I think if profitability improves over the next few years, this could be a great investment. Workday is in a similar position. This is a company that is critical HR tools for a lot of businesses around the world, including a lot of Fortune 500 companies. Revenue is up 64% in the last 3 years, but the stock is actually down slightly at 3.3%. Once again, these kind of companies have fallen out of favor with the market, but I think there's a lot to like given the stickiness of Workday's business and the fact that the company has generated $1.2 billion of free cash flow over the last year. Now, this is still a very valuable company, but it does trade for 37 times free cash flow right now. And given the SaaS business's renewed focus on profitability, I think this could be a potential value. This could potentially be a great entry point for investors. When you think about Workday, this is an even stickier business than DocuSign. Companies are building their entire HR systems around Workday. So this is a multi-year, potentially multi-decade relationship that companies are getting into when they take on Workday as a piece of software that they're using. As a result, the company should be able to grow revenue steadily over time, and if it starts to rein in costs like a lot of other SaaS companies, profitability should grow even faster due to operating leverage. If you like the software as a service business in enterprise, this is, I think, one of the great places to be right now. The final company I'm going to highlight here today is HubSpot. This is a little bit smaller company, but it's very critical for a lot of businesses to do their CRM tools, marketing, sales, services. If you've ever seen those little chat icons in the corner of a website, oftentimes those are powered by HubSpot. So it's able to add things like artificial intelligence tools and try to automate some of the back-end solutions and customer service interactions that a lot of companies have. I think that's going to be of growing importance in the future, especially as a lot of these AI tools get better and better. HubSpot is going to be the kind of company not necessarily building AI, but leveraging it to make its business more valuable. You can see here that the stock has actually done fairly well over the last few years, up 89% in the last 3 years, but revenue is up 126%. So once again, revenue growth is outpacing the stock's performance. This is a big reason why. Negative $113 million in net income. But once again, just like all these other companies that we have talked about, HubSpot is generating positive free cash flow of $186 million. That leaves it in a much stronger financial position than companies that are burning cash, even though it doesn't have positive net income right now. Like DocuSign and Workday, I think this is the kind of business that businesses lean on to be more efficient and provide better service to their customers. That's not something that they're easily going to be able to cut back on, even if they're trying to cut back on expenses to expand their margins. So HubSpot should be in a fairly good position heading into 2023. I think this could be a steady growth company, and if it can get more operating leverage, improve that bottom line and free cash flow, that would be a real positive for the stock. So 3 SaaS businesses that I'm much more interested in today than I was a year ago: DocuSign, Workday, and HubSpot. What do you think about those 3 stocks? I'd be interested in your comments in the comments section below. Follow Riiv Investing here on YouTube. Thanks for watching. I'll see you here next time.